If you're an Australian pensioner, what I'm about to share with you could directly affect the money hitting your bank account this July. These are not minor tweaks. These are real changes that thousands of Australians on the age pension, disability support pension, and carer payment are already asking about, and if you're not prepared, you could be caught completely off guard. Welcome to Centrelink Brief, the channel that cuts through the confusion and gives you straight, reliable information about your Centrelink entitlements, payments, and rights. If you haven't subscribed yet, now is the time, because this kind of update is exactly why this channel exists. So let's get straight into it. What is actually changing in July 2026, and what does it mean for your pension? The first thing you need to understand is that July marks the beginning of a new financial year in Australia, and with every new financial year comes a fresh round of adjustments to Centrelink payment rates, income thresholds, and asset test limits. This is not unusual, it happens every year. But what makes July 2026 significant is the combination of factors coming together at the same time, and the cumulative impact on pensioners across the country. Let's start with payment rates. The age pension, like most Centrelink payments, is indexed twice a year in March and in September. However, the start of the financial year in July often triggers related changes that affect how much money pensioners actually receive. Thresholds that determine your eligibility and your payment amount are recalculated, and even small shifts in these numbers can mean the difference between receiving a full pension, a part pension, or nothing at all. For the 2026-27 financial year, the income and assets tests have been updated. If you are a single pensioner, the income-free area, that is, the amount you can earn before your pension starts to reduce, has been adjusted. The same applies to couples. What this means in practice is that if your circumstances have changed, if you've picked up a part-time job, if you've received an inheritance, or if your superannuation balance has shifted, your pension payment could be affected. Centrelink uses what is called the means test to assess both your income and your assets, and both of these are impacted by the July recalibration. Now here is where many pensioners get caught out. Centrelink does not always proactively contact you when these changes occur. It is your responsibility to ensure that the information Centrelink holds about you is accurate and up to date. If you have assets that have increased in value, property, shares, managed funds, and you have not reported this, you could find yourself in a situation where you have been overpaid, and Centrelink will want that money back. That is a stressful situation that is entirely avoidable if you stay on top of your reporting obligations. Another major area of concern heading into July 2026 is the deeming rate. Deeming rates are used by Centrelink to estimate how much income your financial assets, things like bank accounts, term deposits, and shares, are earning, regardless of what they are actually earning. Many pensioners have felt that deeming rates do not reflect the real world, particularly during periods when interest rates have been volatile. If you have significant financial assets, understanding how deeming works and how the current rates apply to your situation is absolutely critical. There is also the matter of rent assistance. If you are a pensioner renting privately, you may be entitled to rent assistance on top of your pension payment. The thresholds for rent assistance are also updated in line with the financial year, and given the ongoing pressure on rental prices across Australia, this is something every renting pensioner should check. If your rent has increased but you haven't updated your details with Centrelink, you may be missing out on additional support you're legally entitled to. For those on the disability support pension or carer payment, the July changes are equally relevant. Payment rates for these payments are also subject to indexation and threshold adjustments, and the same income and assets test rules apply. If you are a carer receiving carer payment and the person you care for has had a change in their care needs or living arrangements, this could also trigger a reassessment of your entitlement. One more thing worth flagging is the pension supplement and the energy supplement. These are additional amounts paid on top of the base pension rate, and they are designed to help pensioners with everyday costs including utilities, phone, and internet. These supplement amounts are also reviewed and can change with the financial year. If you are not currently receiving the pension supplement, it is worth checking whether you qualify. So what should you actually do right now? The answer is straightforward. Log into your MyGov account linked to Centrelink and review your current payment details. Check your income and assets information. Make sure everything is accurate. If you've had any changes in your financial situation over the past 12 months, update your records before the new rates and thresholds kick in fully. If you are unsure about anything, contact Centrelink directly or speak with a financial information service officer. This is a free service available to all Centrelink customers. Knowledge is your greatest protection. The pensioners who get caught out by these changes are almost always the ones who assumed nothing had changed and didn't check. Don't be that person. Thank you for watching Centrelink Brief. If this video helped you understand what's coming in July, please hit the like button and share it with a family member or friend who is on a pension. They need to know this too. Subscribe to Centrelink Brief so you never miss an update, and leave a comment below if you have a question about your specific situation. We read every comment and we're here to help. Stay informed, stay protected, and we'll see you in the next video.